Joining us now is an investor who says Asian stocks may actually be a safe haven for slowing growth. James Thom is investment director at Aberdeen Standard Investments. You're based in Singapore.
I am.
And just looking through a lot of your comments, we need to return to the realization that the fastest growing region of the world is the Asia Pacific. I mean, even after accounting for all these things, that 63%, you point out, 63% of global economic growth and purchasing power is generated in the Asia Pacific. So even with all these other tensions and geopolitical concerns in the backdrop, it's a fast growing area where valuation has come down because of these other factors. So buy. You don't need
simply,
to be here.
Yes.
You don't need to be here. Yeah.
Thank you.
Yeah, you're welcome.
No, it is the world's fastest growing region. I think the IMF recently published a report forecasting over 5% GDP growth for 2020. So that's fueling, if nothing else, a strong consumption story in Asia. I think for the most part, you look at corporates in Asia from a more bottom-up perspective, we see companies with healthy balance sheets that can, for the most part, weather the macro headwinds, and of course there are headwinds. So from a fundamental perspective, I think Asia still looks pretty compelling. And as you say, from a valuation perspective too, the region is trading at a significant discount now, with certainly relative to the rest of the world and to the US markets hitting all-time highs. I think we will see a rotation into Asian equities.
And your base case doesn't even include any type of resolution to any of the trade issues. You're assuming that doesn't happen and still recommending these stocks.
Yes, I think clearly if we have a deal struck on that, then clearly markets.
What do you mean that the orthodoxy of monetary policy in Asia means that it's better positioned than Western peers? They have more room to ease?
They do. So I would argue that Asian central banks and governments have pursued orthodox policies. So there was never the raft of quantitative easing from 2008
So they have
onwards.
that left.
So interest rates are still high, and that gives them the flexibility now to cut and to support fading economic growth. And on the fiscal side too, balances are reasonably healthy. So there are tools in the toolkit to respond to short-term weakness in economic growth.
We think of the United States as an advantage because we can be a domestic economy and maybe be okay without China, or they have more to lose. You point out China is well on their way to being a domestic economy in terms of a rising middle class and less exports and more consumption. Really? Are they? Because that's the question. It's taking a while.
It's taking a while. It's a big ship to move, but
yeah.
That transition is already happening. I think if you break down the GDP, you can see that services and domestic-focused sectors are now more than 50% of GDP. So that transition is happening. It's been going on for a number of years, and it will continue and help insulate it from the trade
So
issues.
how would a normal investor in this country decide to do that, with ETFs or something for domestic Chinese equities?
Well, we run a domestic active fund, and I think actually an active approach is the right approach to these markets, rather than buying into a passive ETF.
Really?
I think you have to be selective on the companies.
Okay.
It is a relatively riskier market. Plenty of people have lost money in the Chinese equity market, so being selective, picking stocks with good, strong fundamentals, healthy balance sheets and cash flows, I think is the right approach for that market.
There is an Elliott Management note that's out right now saying that they are supportive of the AT&T announcement. They are looking for the separation of the chairman and CEO roles, but not until the CEO transition takes place, which AT&T said will not take place.
Will not take place in 2020. So the question is, when will that take place?
James, thank you.
Thank you.